The next rule I want to tell you about, one that I've developed based on 30 years of investing insights, is among the most important I can ever teach you. And that is that price, the entry price that you buy a stock, matters. Price matters so much, it means you can buy the stocks of companies you don't like all that much if they go low enough and become attractive because of price. In fact, for the right price, even inferior merchandise is worth buying, as long as it's not deteriorating. Some of the best opportunities I have ever seen have come from holding your nose and buying the stocks of companies that you never imagined wanting to own in the first place, because they just finally become so darn cheap. Now, I will never on this show endorse a stock when I think the fundamentals of the underlying company are deteriorating. And I won't go near anything that could be headed toward bankruptcy. Remember, accounting irregularities equals sell. But there's a whole lot of space between best of breed and one that's currently uninvestable. In normal circumstances, though, the stocks of the lowliest companies that still pass the smell test sell for much more than I would ever be willing to pay for them. Usually because there are too many hopeful investors speculating unwisely on a low-dollar stock and buying barely adequate merchandise because it looks cheap, when in fact it's just selling for the appropriate discount, selling where it should be. However, if the price drops far enough, then it's perfectly okay to buy a stock when you merely have a low opinion of the underlying company. That is how much price matters. Now, I get enormous volumes of hate mail on this subject, too, normally from people who are upset that I recommended selling a company that I previously said I liked after a big increase in its share price. Just as even best-of-breed companies become too expensive at nosebleed heights, there are levels where worst-of-breed companies are cheap enough that I need you to pull the trigger and do some buying. Notice, worst of breed is different from just plain worst. A worst of breed business might not look like much compared to its best of breed competition, but at least it can get into the dog show. How do you know when the price is right on something you wouldn't otherwise buy? Obviously, there's a sliding scale here. The better the company, the more you should be willing to pay. If you're speculating, then it's worth looking for companies that have been left for dead, even though they still have a perfectly strong pulse on close inspection. We're avoiding these, but we're looking for others that could just be a little scary, but might be healthy. There's no price you should be willing to pay for a company that could potentially under. None. But if you're truly convinced that bankruptcy isn't on the table and the street just has it all wrong, then buying an unattractive company at an attractive price could make a whole lot of sense for you. When it comes to higher quality stocks, it's harder to find situations where something that doesn't interest you suddenly becomes worth buying because the price is right. Simply because there aren't many times when a half-decent stock trades down that low that I would want to pull the trigger. But if you keep your eyes peeled for companies raising money through equity offerings, which doesn't take much of an effort in an environment where there are so many trying to raise capital through secondaries to pay down debt that they otherwise couldn't, you can often find great deals on merchandise that you would never have looked at once, let alone twice. Just in terms of price, on the same day, May 13th of 2009, both Ford Motor and BB&T, that's a Southern regional bank that had a lot of bad loans on its books, but still looked like the survivor, sold stocks at radically discounted prices to where they were just a few days before. Ford secondary priced at a 5% discount to the previous day's close and a 24% discount to the previous week's. BB&T sold stock at a 10% discount to the previous day's close and a 27% discount to the close the week before. Before BB&T got the deal done, the market was softened, so the price was able to spring back after the secondary. That, plus the fact that the company was worth a heck of a lot more after it raised the money than before because its solvency was no longer in doubt, taken off the table, that made the secondary offering a steal. Both deals immediately made you money. I don't care if you traded them or not. You made money. Even if you had no prior interest in either Ford or BB&T and thought they were both mediocre at best, as I did, at discounts that steep, both stocks were clearly great buys. Always keep your eye on the price, because even less than stellar companies can turn out to be big winners if you get a chance to buy them low enough. Do you know the ultimate example of this worst of breed buying that was so prescient was AMD at the bottom at the end of 2008. AMD, semiconductor company, hated here in Cramerica and by me 22 years. I hated it for 22 years. But when it hit $2, after agreeing to sell its problematic foundry division, and after its graphic chip division began to take share from market leaders Intel and NVIDIA, the opportunity was too great. I called this one a hold your nose and buy situation. And if you listen to me, you caught a double in a matter of months. Here's the bottom line. Price forces you to make new judgments about bad merchandise that you previously shunned. Just as some fixer-uppers have a price that you wouldn't want to pay in another time, stocks can get so cheap that they become diamonds, clearly rough diamonds, but diamonds none the same.